You finally worked up the courage to start investing. You opened an account, put in your hard-earned money, and made your first purchase. You felt excited, maybe a little nervous, but proud that you were finally taking control of your financial future. Then a few months later, you checked your account and your stomach dropped. You were down 20%, or you sold too early and missed massive gains, or you realized you'd been paying fees you didn't even know existed. You thought you were doing the right thing, but somehow you still got it wrong, and now you're wondering if investing is even for you. Here's the truth. Almost every beginner makes the same devastating mistakes. And these mistakes cost them thousands, sometimes hundreds of thousands of dollars over their lifetime. But the good news is that these mistakes are completely avoidable once you know what they are. Today I'm going to walk you through the biggest investing mistakes that beginners make, show you exactly why they're so costly, and most importantly, tell you how to avoid them so you can actually build wealth instead of losing money. The first massive mistake beginners make is trying to time the market. This is when you try to predict when stocks are going to go up or down and buy or sell based on those predictions. It sounds smart in theory. Buy when prices are low, sell when they're high, and make a fortune, right? So the problem is that nobody, and I mean absolutely nobody, can consistently predict short-term market movements. It's not professional investors with decades of experience. It's not hedge fund managers with teams of analysts, and definitely not someone who just started investing last month. Let me tell you what this looks like in real life. You're ready to invest $1,000, but then you see a news article saying the market might crash soon, so you decide to wait for the dip. But the market doesn't crash. Instead, it goes up 10% over the next 3 months. Now you're kicking yourself because if you had just invested when you were ready, you'd be up $100. So you decide to wait even longer for it to come back down, but it keeps going up. A year later, the market is up 20% from when you first wanted to invest. And you're still sitting on cash hoping for a crash so you can get in at a better price. This is called trying to time the market, and it's one of the fastest ways to miss out on gains. Here's what actually works. It's called time in the market, not timing the market. Instead of trying to predict the perfect moment to invest, just invest as soon as you have money available and then stay invested. Study after study has shown that people who just invest consistently and stay invested over long periods do way better than people who try to jump in and out based on what they think is going to happen. Even if you invest right before a crash, if you just hold on and keep investing through it, you'll come out ahead in the long run. I know it feels smarter to wait for the perfect entry point, but you're essentially trying to outsmart the entire global financial system, and the odds are massively against you. The second huge mistake beginners make is picking individual stocks instead of investing in index funds. This one is tempting because we all hear stories about people who bought Apple or Amazon early and made a fortune. See headlines about stocks that doubled or tripled in a year, and we think, I could do that. I'll just pick a few good companies and watch my money grow. But here's the reality. The vast majority of individual stocks either underperform the overall market or go to zero. For every Apple success story, there are hundreds of companies that failed or went nowhere. Even professional stock pickers, people who do this full-time with enormous resources, struggle to beat simple index funds over long periods. Multiple studies have shown that over 10 or 20-year periods, something like 80 to 90% of professional fund managers fail to beat the S&P 500 index. Let me give you a real example of how this goes wrong for beginners. You decide you want to invest in technology, so you pick 3 tech stocks that seem promising based on some articles you read and things you've heard. You put $1,000 into each. One of them goes bankrupt within 2 years, and you lose the entire $1,000. Another one stays basically flat, going nowhere for years. The third one actually does well and doubles, so you make $1,000 profit. Overall, you started with $3,000, lost $1,000, broke even on $1,000, and made $1,000 on the third stock. You end up with $3,000, the exact same amount you started with. Meanwhile, if you had just put all $3,000 into an S&P 500 index fund and left it alone, you might have ended up with $5,000 because the broad market went up. You worked way harder researching individual companies, took way more risk, and ended up with worse results. This isn't to say you should never buy individual stocks. Some people enjoy it, and want to dedicate time to learning about companies and industries. But for beginners, especially if you're not planning to spend hours every week doing research, index funds are almost always the better choice. They give you instant diversification across hundreds of companies. They're low cost, and they match the market's performance, which historically has been pretty good over long periods. You're not trying to beat the market, you're just capturing what it does, and that's more than enough to build serious wealth. The third critical mistake is panicking and selling during market downturns. This is probably the single most expensive mistake beginners make. Here's how it happens. You invest money in the market, things are going well for a while, you're feeling good, then the market drops. Maybe it drops 10%, maybe 20%, maybe more. You open your account and you see that you're down $1,000, $2,000, maybe more. Your stomach churns. You start reading scary headlines about recessions and crashes. You imagine your money disappearing completely, so you sell everything to stop the bleeding, thinking you'll get back in when things calm down. And that's exactly when you lock in your losses and miss the recovery. Let me walk you through what actually happens when you do this. Let's say you invested $10,000 and the market drops 20%. So your account is now worth $8,000. If you sell at this point, you've actually lost $2,000. It's gone. You converted a temporary decline on paper into a permanent real loss. But if you had just held on and done nothing, what typically happens? Markets recover. Sometimes it takes months, sometimes a couple of years. But historically, markets have always recovered from crashes and gone on to reach new highs. That $10,000 investment that dropped to $8,000 would eventually recover to $10,000, then $12,000, then $15,000, and beyond. But only if you stayed invested. The people who sold at $8,000 locked in a 20% loss and then usually got too scared to buy back in until the market had already recovered, meaning they missed the entire rebound. I've seen this happen to so many people. They invest, see their account drop during a downturn, panic and sell, and then watch from the sidelines as the market recovers without them. They lose money twice, once from the drop and again from missing the recovery. The key lesson here is that market drops are completely normal and part of investing. They're not a sign that you should sell. They're often the best time to keep investing, or even invest more if you have extra cash available. I know this is easier said than done. Watching your account value drop is genuinely stressful. But understanding that it's temporary and part of the process is crucial. If you can't handle seeing your account balance fluctuate, you might have too much invested in stocks and should consider having more in bonds or cash. But selling in a panic is almost never the right move. The fourth mistake beginners make is not investing regularly and consistently. A lot of people invest once, put in a chunk of money, and then just leave it. They don't add to it consistently, or they invest only when they feel like the market is doing well, which usually means they're buying when prices are already high. The better approach is dollar cost averaging, which just means investing a fixed amount of money on a regular schedule, like every month or every paycheck, regardless of what the market is doing. This strategy has multiple benefits. First, it removes the emotional decision-making because you're not trying to time the market. Second, it means you're buying when prices are high, when they're low, and everywhere in between. So, you average out your purchase price over time. Third, it builds a habit and ensures you're consistently adding to your investments, which is how wealth actually gets built. Think about it this way. If you invest $200 every month for 30 years and earn an average 8% annual return, you'll end up with around $300,000. But if you just invested a lump sum of $10,000 at the beginning and never added to it, you'd end up with around $100,000. Both are good, but the consistent monthly investor ends up with 3 times more money. Even though they only contributed a total of $72,000 over those 30 years compared to the $10,000 lump sum, the consistent contributions combined with compound growth over time create wealth. Set up automatic investments so you don't even have to think about it. Every month, money gets pulled from your checking account and invested automatically. This removes the temptation to skip months or to try to time your purchases. Another common mistake is paying too much in fees. This one is sneaky because fees seem small. You might see that a mutual fund charges a 1% annual fee and think, 1%, that's nothing. But over time, fees compound, just like returns do, except they work against you. Let's say you invest $50,000 and it grows at 8% annually for 30 years. With no fees, you'd end up with over $500,000. But if you're paying 1% in fees every year, you'd end up with around $370,000. That 1% fee cost you over $130,000. That's not a small amount. It's life-changing money you gave away just because you didn't pay attention to fees. This is why index funds are so powerful. They typically charge expense ratios of less than 0.1%, sometimes as low as 0.03%. Compare that to actively managed mutual funds that often charge 1% or more, plus sometimes additional sales charges or loads. As a beginner, always check the expense ratio before you invest in any fund. Anything over 0.2% for a basic stock index fund is probably too high. You want to keep as much of your returns as possible, and minimizing fees is one of the easiest ways to do that. Beginners also make the mistake of not diversifying enough. Diversification just means spreading your money across different investments so you're not putting all your eggs in one basket. Some beginners invest everything in one or two stocks, which is incredibly risky. If those companies fail, you could lose everything. Others invest only in one sector, like putting everything in technology stocks. If that sector crashes, your entire portfolio crashes with it. The smart approach is to spread your investments across many different companies, industries, and even countries. This is another reason why index funds are great for beginners. A total market index fund gives you exposure to thousands of companies across all sectors of the economy. If one company or one sector struggles, it's just a small part of your portfolio and doesn't sink the whole thing. Another mistake is investing money you're going to need soon. Stock market is volatile in the short term. If you invest money you need in 6 months for a down payment on a house, there's a real chance the market could be down when you need to sell. And you'd have to take a loss or delay your plans. As a general rule, only invest money you won't need for at least 5 years, preferably much longer. For short-term goals or emergencies, keep money in a savings account where it's safe and accessible. Investing is for long-term wealth building, not short-term savings. Beginners also often fail to take advantage of tax-advantaged accounts. If you're investing in a regular taxable brokerage account when you could be using a Roth IRA or a 401k, you're potentially leaving thousands of dollars on the table. These retirement accounts offer huge tax benefits. With a Roth IRA, your investments grow completely tax-free, and you never pay taxes on the money when you withdraw it in retirement. With a 401k, you might get an employer match, which is literally free money, and you get a tax deduction now. Before you invest in a regular account, make sure you're maxing out these tax-advantaged options if you're eligible. The tax savings compound over decades and can make an enormous difference in your final wealth. One more mistake worth mentioning is following tips and hype instead of having a real strategy. Beginners hear about a hot stock from a friend, or they see people on social media talking about some investment that's supposedly going to explode, and they jump in without understanding what they're buying. This is how people end up investing in things like random cryptocurrency, projects, or meme stocks, and then losing most of their money when the hype dies down. Investing should be boring and methodical. You should understand what you're investing in and why. If you can't explain why you own an investment beyond someone on the internet said it was going to moon, you probably shouldn't own it. Have a plan. Stick to simple, proven strategies like index fund investing and ignore the noise. Before we wrap up, I need to remind you that everything I've covered in this video is for educational purposes only and not financial advice. I'm not a financial advisor, and your situation is unique to you. Do your own research and consider consulting with a licensed professional before making investment decisions. My goal is to help you avoid common pitfalls, not to tell you exactly what to do. So here's the summary of what not to do. Don't try to time the market. Don't pick individual stocks unless you really know what you're doing and are willing to accept higher risk. Don't panic and sell during downturns. Don't invest sporadically. Don't ignore fees. Don't fail to diversify. Don't invest money you'll need soon. Don't skip tax-advantaged accounts. Don't follow hype without understanding what you're investing in. Avoiding these mistakes won't guarantee you'll get rich, but it will dramatically improve your odds of building wealth over time. The difference between someone who makes all these mistakes and someone who avoids them could easily be hundreds of thousands of dollars over a lifetime. The good news is that you now know what these mistakes are, which puts you ahead of most beginners. You can start your investing journey on the right foot by choosing a simple strategy, like investing consistently in low-cost index funds through tax-advantaged accounts, staying invested through ups and downs, and ignoring short-term market noise. That's not exciting or glamorous, but it works, and it's how most people actually build wealth. If this video helped you understand what to avoid as a beginner investor, I'd really appreciate it if you hit the like button. And if you want to keep learning about investing the right way, building wealth, and avoiding costly financial mistakes, go ahead and subscribe to the channel. In the next video, I'm going to show you exactly how to build a simple beginner portfolio step by step that avoids all these mistakes and sets you up for long-term success. Thanks so much for watching, and I'll see you in the next one.